Two time frames, same rules, same month, and same $10,000 starting balance. After just 17 trades on each, they both came in at nearly 20% P&L, and I didn't see that coming. My name is Vi, and this is my 15-minute versus 30-minute opening range breakout test. Month 1 of a head-to-head battle that I'm running by hand, one trade at a time. Before we discuss how the trades went, let's set up a few ground rules, because this only means something if the playing field is fair. So we'll start off with the same pair on each, Euro USD. We're going to build the exercise from January 2026 and build from there. Each will start off with the same $10,000 starting balance, same risk per trade, 1%, and same take profit structure, a 3R risk to reward. And I'll execute the trades using the same rules on each. As soon as price breaks out of the range and takes a significant high or session liquidity high, I'll get in on that candle close. I'll set my stops at the bottom of that candle, of that same candle, and set a 3R trade. No guessing and no intuition. I'm trying to set this up as mechanical as possible to enable a set and forget process. After 1 month, I ended up with 17 trades on each test, 15-minute and 30-minute. Same market, same rules, same money. If I changed anything between them, then this comparison would be pretty useless. I didn't, but let's get into it. So what did 17 trades on the 30-minute breakout look like? The thing that surprised me is that it's pretty boring. Day after day, I executed the same rules. Candle breaks the opening 30-minute range. I get in, and I wait for take profit to hit or my stop loss to get touched. Now, I had some wins, and they were the easy ones. I would set up my trade, walk away, and a few hours later, or maybe even the next day, my take profit would get hit. But the losses told the real story. Because here's what I noticed. My losers weren't because the setup was wrong. They were wrong because sometimes I got greedy. I'd see a break and have to chase the entry because price was moving with momentum. As a result, my stop losses were a little bit wider than usual, but the 30-minute chart doesn't punish you as quickly for that kind of change. Because of the amount of time each candle represents, it's easy to get comfortable, and that's where that comfortable can get dangerous. By the end of the month, the 30-minute chart had given me clean, winning trades, and a day win rate that was honestly lower than I expected. But the average win per trade, that's where this strategy quietly made me my money. Now, the 15-minute candle is a completely different story. It felt like I had more setups. I had the same amount of trades at 17, but the energy was a little bit different. The candles are coming in quicker, and the levels are being tested much faster. And honestly, it can get hard to sit on your hands when you're waiting for the candles to tell the story. Because of the time difference, the win came faster. The 15-minute lets you get in and out with tighter stops, so your return is bigger if you choose to leave a runner. But here's the trade nobody warns you about, the dueling trade problem. So now we're actually in dueling trades, which may not be possible on certain proper accounts. We get stopped out for that first. We get stopped out on that second trade almost immediately. In this example, it was more likely to find myself in a long that was running from the previous day. The rules said I could stack orders, but when my rules told me I had to take a short, the second trade would get stopped out instant. One day, 2 trades in opposite directions. That's the price of more setups. More opportunities can mean you have more chances to get chopped up. So I made a rule only 1 trade a day on the 15-minute chart, and that helped change things. I had the same setups and much less noise, and the day win rate told the story at 60%, higher than the 30-minute chart. But I had to earn that win rate by fighting my own impulses, not to overtrade. This is an early moment that clicked for me. January 7th. Take a look at the chart on the right, which is our 15-minute price action. The yellow lines mark up the top and bottom border of the first 15-minute candle to print after the 9:30 open. Notice the white candle that takes the structural high marked by the blue dot. That's the point where we take our entry and set up our trade. Pretty textbook and following my rules. But watch what happens when the next candle prints. We immediately hit stop loss. The price starts to move lower. Now take a look at the chart on the right, showing our 30-minute price action. The candle marked up in green is our 9:30 open. The yellow lines mark the top and bottom borders of that candle. Notice that price doesn't move above this top yellow line immediately. Instead, price has more time to show its hand. It starts moving lower, and it's not until later in the day that we end up taking a structural low marked up by the blue dot. This is where we can take our entry, and price eventually hits take profit the next day. Same day, different result. The 15-minute chart had me jumping in too early, but the 30-minute chart gave me a chance to sit and watch the bigger story play out. And that was a key takeaway for me. The higher time frame gave me a different type of information, and it helped me ignore the noise, and that could be its real edge. Alright, here's where the numbers actually talk. 17 trades each. Net result, both came back at 19.13 per P&L, identical. And I didn't see that coming. The trade win rate at 52.94% on both. Again, identical. But then it splits. The day win rate, the 50-minute, 60% to 46%. The average win per trade, the 30-minute opening range breakout strategy took this one. Bigger and cleaner. So here's what the month actually told me. The 15-minute chart wins more days, but the 30-minute chart makes more money per trade. Same money at the end of the day, but a totally different trading experience getting there. So which one's actually better? I'm not going to tell you it's a slam dunk. That's exactly why I'm testing this month to month. If you trade by hand and don't leave everything to an algorithm and want to see which setups genuinely perform, not hype, just the data, then subscribe. I run tests like these every month, so you don't have to. So here's my honest takeaway. 17 trades is barely directional, and it's certainly not proof, but it is month one of a track record I'm building in public, and that's worth more than any one single conclusion. Next up, I'm pitting the VWAP strategy against the 30-minute opening range breakout strategy to see if adding a VWAP filter beats a pure breakout strategy setup. And that's a test I genuinely don't know what's going to happen. If you'd like to see a few videos where I backtest my fair value gap, then start with this video here, and I'll see you there.